All right, I can't wait to jump into today's topic. This is a hot one because so often to clients, actually, I mean, there's some places that you go to and, you're instantly like, oh man, this was a great service, good food. You tell everybody there was value. One thing you don't bring up is price. And say like a steak 48. Steak 48 is expensive, but everybody talks about it. It's always crowded. And you might look at another restaurant like a Chick-fil-A. It's crowded. I don't hear anybody ever talk about the cost of it.
No, it's like it's like a known. Like, hey, you're gonna pay a little more, but it's worth it. Yeah. The kids love it, parents love it. It's easy. It seems healthier than some of the other places.
It's definitely got us
which
fooled,
could be
if not.
debated.
I heard there's 54 ingredients.
The kids even use that on me. They're like, it's healthier. I'm like,
Yeah.
So
fast
I was thinking about the conversation that we'll have from time to time about fees in our business. Hot topic, right? Mm-hmm. And the other day I was taking a walk and I'm like, you know what? Everybody thinks and everybody believes if you Google, like, what's the average advisor cost? It's going to come up with that typical 1%, right? Mm-hmm. So I'm like, okay, what if we like zoomed way out? What if fees were like an iceberg? And that 1% is the thing that you see, but there's so much below the surface that we don't. So I'm like, what if we just made it really simple and we're just like, how much money is in the financial space and how much revenue is being charged? Like, what's the top line revenue that customers, like we all, like in our banks, financial institutions, wherever money is, how much of that is out there in the United States and how much is the United States profiting on that money? So let's just see if we can blow up, that 1% myth, because I've been saying for my whole career, like there's way more money being made than 1%. Like I'm a business owner. I know what we charge. And I'm like, we can't afford to put a commercial on TV.
Let alone every commercial break.
Yeah.
Right.
For a major sport or let alone the Super Bowl. And yet it feels like the number one industry advertising in all the major events is the financial institutions. And I'm like, how can they afford to do this? Yeah, well, they have more money to be managed. Well, the more money you manage, the less you charge.
Right.
So how much, and I know what they have under management, and it's not free to have all those big buildings uptown.
I was just going to say, we've got a really nice building.
Yeah.
But don't want to hurt you, Paul.
There's
some up there that are maybe got us beat.
Well, they're beautiful.
They're beautiful. And they have,
When I
got to be paid for.
When I first started at Morgan Stanley, I was it was one of like 7 buildings in Detroit. And it was probably the worst one. Mm-hmm. And it was like marble walls.
Yes.
Like
beautiful.
Marble everywhere. There's marble in the bathroom. There's marble down the hall. I mean, there's marble on the ceiling at certain points. And it was one of their smaller locations, and we housed like 200 advisors at the time.
Yeah.
Multiple floors. Like we had an entire floor for teaching. Like it was crazy. There's a cost for all of that.
Right.
And where's the cost come from? So it was really fun. Now, before we dive into some of the numbers that we found, I think it'd be really appropriate to kind of talk about what this 1% is. So if you go out and Google or ask chat, like what's the typical cost in the industry, what's it going to come up with?
It's going to say your advisor's getting 1%.
1%.
Yeah.
Right.
And which
or you should be charged.
Right.
1%.
Stay away from people that are charging more than 1%.
Right.
Yeah.
Red flag.
Yeah, you shouldn't be. Yeah.
Right.
So, which it seems reasonable. There's nothing right or wrong. It's just it's a known fact.
It's like the industry standard.
It's a belief
Yeah.
that that's what the industry is making, 1%. And you look at that and you're like, hey, that's fine. Yet, in the early days of my career, when I went to an independent, I was at Morgan Stanley for many years, and we charged that 1%-ish. And then we talked to some advisors, and that was back in the days where they were charging commission. So it wasn't even the 1% back then. It was more commission. And you would make X%. Sometimes it was way higher than 1% on a trade, on a single trade. So if you had $10,000 on the trade or $50,000 on the trade, you would charge like 1% on that trade, sometimes a little bit higher. And then 2 days later, if they sold, you would have charged again.
Right.
So this was like the shady practices. It was totally legal, but every time there was trade, there was money to be made. And it was percentage game early on. Then they went to fixed cost, and then they ultimately deleted it. It's not even there anymore. So when you look at way, way, way back when, the cost of that stuff was super high. And you'd been happy to pay 1% in a year when some advisors were paying 5 and 6, 7%.
Yeah.
Because
how much trading was
all that
there
activity,
down.
and then you heard the churn factor and all the, don't be paying that commission. Glad we don't live in that world anymore.
Yeah.
Now it's like you trade as much as you want, doesn't matter. Okay, so the 1%, there's nothing bad about it. There's no red flags. If you, or like I was starting to say early in my career, that once we got past the commission, I know trading company or asset management companies that are even still today. There's one in Ohio I know of that's like 2.9%. The cost of their management. Then you have the advisory fee, the platform fee. That was just their advisory cost. There's one that trades 401ks that's 2.6. What's Howard? Do you know their? I think it's 2.2. Might be 2.3 or 2.6% a year for them to manage your 401k, which everybody believes is free.
Yeah.
And they're over 2% a year, and I know they are. Okay. So when you hear the 1%, that's not bad. That's totally fine. It's totally normal. It's not necessarily what you're actually paying, although we'll discuss that in a minute. That's just a known fact out there. So let's talk about the raw numbers. Now, I'm going to throw out a big disclaimer here. When I was trying to get this information, I used ChatGPT, I used other AI sources, I used Google, I used other I went all over to find this information. So the information that we're about to talk about may be flawed to some degree, because the first one, what are the total assets in the United States that are held in financial institutions? The number that we're going to use is $63 trillion. Okay. I believe that to be very, very close. Some were going higher, some were going lower. That was the most consistent number I could find. But please know that could be wrong. I don't believe it's much higher than that. I used the higher number that was most consistent, which was 63 trillion. Of that 63 trillion, 18 of it is in cash. Okay, within the bank institutions or financial institutions, which is a very interesting thing. I didn't realize we had that much cash in the United States. $18 trillion.
Wild, yeah.
That is crazy. So these are the two big numbers we're going to use. The reason why I pulled the cash out, it's not 63 plus 18.
Right.
The 18 trillion is in the 63.
Part of the 63.
Okay. So there's about $45 trillion of non-cash assets, bonds, stocks.
Actually invested.
That's actually invested. The reason why I did that, because when I was first doing this, I was like, well, should we handle cash the same way we handle other investments? Because I don't know of a single bank out there that charges on its cash. So I'm like, if we're handling cash different, maybe it will skew the numbers. So I originally pulled it out, but I don't think we should pull it out. I think we should throw it back in there. And let's just use the 63 trillion, not the 45. And you'll know why. So you can go Google, figure out your own numbers. You're going to find right around $63 trillion. Then it was the next big thing. And again, we're just using top line numbers here, because I'm like, well, it should equal 1%, right? Or less, because if there's 63 trillion, then we should have a specific number that should get us around 1% revenue, in total, or so 1% in average fee cost to get to the total revenue, right? So your mind's calculating right now, okay, what would that be? It's way lower than what the actual numbers are. Let me just let the cat out of the bag. So, and this is from IBIS World. I don't even know what that stands for, but this number kept coming up all the time. So, and this is as of
analytics company.
Yes.
Data and analytics.
This is as of 2024. The total revenue was $7.2 trillion, which is crazy. $7 trillion that has been made on a $63 trillion industry. Instantly, my math is going, is that 1%?
If you add a zero.
If you-
Take away a zero.
Did you take some numbers off
You had to
there?
move the decimal point.
Now, one thing I do want to note is when you look up the financial services industry, it's two major things. Because I instantly was like, well, what's making up that 7 trillion? Is there like mortgages in there, like stuff that's unrelated to actual assets in the bank? And it's insurance products, which would be life insurance, annuities, and things like that, and financial services like assets under management, portfolios and things like that. So I want to remove the insurance things. Biggest reason is because it kind of skews the numbers. So of that 7.2, that's total revenue, 1.2 trillion, just under 1.2 is insurance related. So we're going to knock that 7.2 trillion down to 6. So you have $6 trillion. 6 trillion. Like, I wish we had like rice that was like $100. Like every grain was like $100. And how much rice would we have to fill
cover
up
the table
to get 6
We'd have to get out of the room. There wouldn't be room for us.
I don't know how much it would be, but it would be absorbent.
Yes.
Because I do know, I saw this the other day, and it was rice was equal to $100. Might have been $1,000. And how much like Jeff Bezos and Zuckerberg had. In Zuckerberg, you could fill 3 Olympic-sized swimming pools with rice. That's how much money he has.
Oh,
Okay. And then they did, if it was, what's the debt, national debt? And they filled up the entire Empire State Building.
A lot of swimming
with rice. The whole thing, and actually was coming out of the top. With rice. You fill up the entire Empire State Building. That's how much debt is. And there, I don't remember exactly what our debt, does anybody know what our debt is?
36 trillion plus.
I thought it was like 100. Whatever it is. It's a lot. So
news websites have it on a ticker now.
Yeah.
Show it.
It's a whole lot of money,
Yeah.
which we've got $63 trillion. So if it's the same amount of money, we could fill up or
36.
half of the Empire State Building.
Yeah. Crazy.
Okay. Which means 6 trillion. I mean, that's 10%.
Yep.
So I think we can debunk. Remember that Mythbusters show?
Right.
Yeah.
Is this a myth or is it real? Right out of the gate, when you take 63 trillion and 6 trillion is the top line revenue, that's 10%. So, and I know instantly right away, everybody's going, well, I'm not paying 10%. Somebody else is getting robbed. Well, we're going to dig into some of these numbers here in a minute.
Yep. It's actually making up that 10%.
It is making up the 10%, and we can dig into a lot of the reasons why. And at the end of the day, the investor's the one paying for it. You just don't see it. And the subtitle to the show today, it's really the 1% myth, but the subtitle is what the financial industry doesn't want you to go Google or ask Chad. Because you could have some fun, go have a conversation with Chad about the things that we're about to list right now. So what makes up the revenue? Because if the average advisor is only charging 1%, some charge more, some charge less. Where's all that other money? Where's the other 9% coming?
Well, in a lot of scenarios, you have commissions that that still get paid on what you're holding, especially whenever it comes to mutual funds.
Let's dig into that
I
right
was
away.
going to say the mutual funds.
So back in the day when you had Morgan Stanley, Merrill Lynch, Schwab, all the big institutions, they used to charge commissions. Now they don't, because there's a race to the bottom. We
Thanks
just
to
talked about
Robinhood.
Robinhood came out, and they're like, hey, don't pay commissions. Use our platform. So everybody was like, I remember it was like $7 a trade or $8 a trade as his peak.
Yeah.
And then it went down to like 5, 4, and it was a race to the zero.
Yep.
Right.
What was the first institution? I think it was TD Ameritrade. I think they were the first one to go to zero. And then once the big one of the big 5 went, it was like, oh yeah, they all went to zero. And I remember on our platform, like, oh my gosh, it's going to be zero. Now we didn't make any of that. Our clients paid it.
Right.
But it went to the institution. We didn't collect a single dime of that. So if the major institutions, Fidelity, Schwab, Vanguard, all of these companies out there, TD, aren't charging commissions, they are not charging commissions, how are they affording these gigantic buildings in just about every city in the U.S.? Sometimes they have multiple locations. Like, just type in Fidelity or Charles Schwab, Charlotte, and look how many locations are around Charlotte.
Or an Edward Jones.
Or an Edward Jones.
Like every strip mall.
And they don't charge anything.
Right.
The advisor's charging their 1%,
Right.
but the company's not making any extra money. Well, we already know, because if you look it up, we're talking a $6 trillion financial service industry on a 63 trillion. So this 1% lie it's not real. So if they're not charging commissions, how are they charging? Now, one of the things we can talk about is what's called a spread.
Yep.
So when you've got Fidelity or Charles Schwab or somebody, and they've got thousands, hundreds of thousands, and some degree, millions of clients, and you've got all these clients in, let's just pick a stock like an Apple. How many times a day is Apple bought and sold? If you look up volume,
probably millions.
It'd be crazy.
Yeah.
Right.
So every time they're trading, remember those people, you ever seen those movies where they show Wall Street and they got all those people screaming, with the tickets in their hand, and like, let's go, 10 million here.
Yeah.
The institutions are trading on a block scale. The clients are trading on an individual scale. So when you go to place your trade on a minute by minute basis or second by second basis, you might get a stock at $103.32. Somebody else get $103.33.
Right.
Somebody might be 104.
Or
Somebody
if you're
might
buying
be
enough
101.
shares, sometimes it's like 3 transactions to you personally. You'll get like 30 at one price, another 40 at another price, and the final 10 at a different price because it's changing.
So
in between.
the question would be, are there people on the floor, filling your 100 shares of Apple, or some guys 1,000 shares? No.
Not as much anymore.
They're block trading millions of shares or hundreds of shares, thousands of shares at a time for a set price. And they're, going back and forth. So the company might have got it for $100 and might have sold it to you for 101, you 102. Sorry, Cal, you might be 103.
Mm-hmm.
But the reality is, everybody's paying a different price, but the institution is getting the spread between what he got or what they got on a block order for 1 million shares, and then divvied it out to everybody else at a much, higher price.
Yep.
It could work against them. My guess is it's not.
No.
And they're making that. So
they're always making a buffer.
The client is losing out on potentially 1% to 2% on a trade that they do on a single, like in one moment.
Right.
That's $100. They got it for 103. The company might have got it 101, or whatever the spread is. It might be pennies, but we're talking trillions of dollars being moved.
Yeah.
And they're making sense. I mean, how can they not charge a commission and still keep their brick and mortar? They didn't go out of business.
Right.
They're more profitable today without charging it than they were when they were charging a commission.
Yep.
So what am I missing?
Where's the catch? Where's the money?
Yeah. It's still being charged.
Money?
Yeah.
It's still there. And that's just one of all kinds. You've got, trading costs, which we're talking, there's fund expense ratios. If you look up, like, what's the average mutual fund cost? I mean, there's a great Forbes article.
There is. It's about 10 years old, but it still is very true to exactly what is happening.
You want to make
want to
make my blood boil?
Yeah.
Start talking about the internal cost of a mutual fund.
That they don't have to disclose. The only one that they have to disclose is the expense ratio.
Which is always like peanuts.
Right.
Like 15 basis points, 30 basis points, 45 basis points, which means it's 0.4%. But the reality is the mutual fund company is probably charging somewhere between 2.5% and 3.5%, but they don't have to disclose all of that.
Nope, because they can mask it under the return of the holding.
And the actual mutual fund might have made, like, say 13%, but because the expenses are only given 11.
Mm-hmm.
Okay,
so it's 2%. You
2% right off the
They never
top.
had to say a word.
And you know what? Why don't you? What do they call it? Fact check me on that.
Yeah.
This is real. Same things happen to ETF.
Correct.
Same things happen on the trading. Like, you don't get to $6 trillion. I mean, there'd have to be
1%.
To make it 1%.
trillion.
Yeah.
Yep.
At $6 trillion of revenue to make the math work, but it's not. It's 63 trillion and $6 trillion of actual revenue. I mean, the numbers don't lie.
Right.
Fact check it.
Right.
Go look up a mutual fund. Your blood. I can't. That's why I won't sell them.
Yeah.
It's too much cost.
Well, Paul, I'll never forget when I walked into your office. I won't use the company that my husband and I got when, we just started out. And I think I'm pretty savvy. I track the ball. And you weren't saying, I said, I put this much in this many years ago, and this is what I have. And I finally said, what happened? And he's like, well, I don't want to call your baby ugly. Do you remember that? I was almost in tears. My husband and I thought, but it's because we listen to the talking. We look at the headlines and we watch the narrative instead of following the money. And we were paying fees and we were just looking at the growth rate that we thought we were making. And we're both busy working people, pushing out a couple babies and, living life. Well, my husband and I did do it together. I'm calling it with my husband. But no, and I'll always remember when I came over and I missed it.
Yeah.
And you try to have the conversation with somebody and it's a really hard conversation because you don't want to call their baby ugly, but the money is going somewhere and pretty sharp people don't realize it until they really slow down or they go to make a change and they have a conversation. But I'll always remember that. And I was embarrassed.
Well, not to derail it, but sometimes that very thing with the 401k, you forget that you and your company are putting money in. So you just constantly kind of see this growth or stabilizing. Right. And you forget that
I'm putting in $23,000
the same return coming through.
If you want to, I get sick when I look at the fees of all these different things we're talking about, which we don't, most of it, not all of it gets cut out. But I'd say 50 to 80% of these fees don't relate to our clients because of the way we manage money.
Really, the only one is the actual
spread.
Trading, and you have
there's probably other ones in there that we don't know about.
Right.
But the realities are, because I don't know how they're getting to 6 trillion. I mean, they're charging everywhere. I have an idea where we're getting the bulk of it, but there's still some stuff that doesn't add up. But to your point, if you for the average investor out there, you want to go get sick, look up the Dalbar study, the DALBAR. And it's like 35 years old now. They have 35 years of actual investor data. And it'll look at all equity, or a value or a mix of two. And it'll show you what the average investor is making net of fees, real return in their pocket. And we're adding in emotion, we're adding in cost, we're adding everything into here of bad decisions, good decisions, and what's the average investor netting in their pocket. And it's sickening. It's like 1% or 1.25% average over a 30-year period because of all the things we're talking. And we're not even mentioning, the emotional aspect of the market doing its thing and we're making rash decisions or poor decisions. That compounds this. We're just talking about how much money the investors are losing out because of the cost. And there's investors out there that are like, I'll never pay an advisor anything.
Yep.
I mean, don't, go do it yourself.
Right.
And there's people like, I'd never do it by myself. I had a guy yesterday tell me, he's like, I'm to the point where, I've been he goes, I call it pride. I've been so filled with pride that I would never hire an advisor. And he goes, Paul, he's a friend of mine. He's like, I need one now. He's like, would you sit down with me? He's like, I'm to the point where I've got, my business, I've got all this stuff and I can't handle it by myself. Price didn't even come up because there's a need.
Yep.
But the reality is you have cost and you have emotions. Emotions are actually more expensive than the fees you pay.
They'll cost you.
Right.
Because if you make a wrong decision based on your emotion. So the Dalbar study adds everything together and it's sickening because we're so emotional and there's so much cost out there. The investors only realizing like 1 to 3%, on their investments throughout their investing career.
Right.
And you're a perfect example.
And they don't realize it until, and I was 10 years in. It's too much time goes by until you realize sometimes. Right?
Yeah.
Before you really realize.
So we need to land this plane. So if you zoom in and you Google what everybody Googles, and we don't even say that, if you chat, AI,
search wherever you search.
you're going to see that typical 1%. But if you start doing what we started doing and digging in and looking below the surface, there's so much more money being made at the investor's expense than what we see. It's that big iceberg. There's a whole big body below below the surface of the water of money being made. And if you have more information that we weren't able to figure out on how the investor's not paying this, I don't know who is.
Yeah, come in and we'll do the next podcast.
Yeah, I'd love to interview you. If you're a specialist, or you want to debunk my debunk, let's go. Like, I would love to know the reality behind where all this money is being profited from. because I'm certain I know exactly how it's being made, and the client's paying for it, the customer, the investor, me, you, everybody, like we're included.
That's
We
right.
got money in the market too. Any last words?
No, I love doing the research around this and just kind of figuring out, digging a little deeper. But it's definitely your 1%'s up top on the iceberg, and you got about 9% below the surface.
Yeah.
That makes me so mad. Do your research. Don't take our word for it. Dig into these numbers. You're going to come to the same conclusion, and it'll change the discussion, I think, greatly. So hope you enjoyed. God bless.
Subscribe.
I was going to say that into tonight.